Right then, you lot. Big Short Club is live. No messing about. Let's get straight into it. Morgan's in the building.
You know it. What's the good word, people?
The word is carnage, mate. The markets are on a mad one. Bitcoin's doing the cha-cha slide between 50 and 60k.
Yeah.
And I hear you old-timers in the stock market are feeling the heat too.
Feeling the heat? It's a proper pressure cooker, bruv. 1 minute, the footsie's looking like it's going to the moon.
Right?
The next, some suit says the word inflation, and bang, everyone runs for the exit. It's a treacherous game right now.
Exactly. So we're going to talk about the one thing that stops you from losing your shirt, your house, and your dignity. Risk management. This is the real alpha, the proper CMT level 2 gear, but we're breaking it down for the lads on the street. So Morgan, when the market's moving like a bag of angry wasps, what's rule number 1?
It's dead simple.
Yeah.
But everyone gets it wrong. Emphatic. Position sizing. Forget your fancy indicators for a second. This is the foundation of the whole gaff. It's not about being right. It's about how much you lose when you're wrong.
Say it louder for the people in the back. In crypto is a horror show. You see these kids on Twitter, 125x leverage on some coin named after a cat.
Oh, yeah.
They flash one big win, then you never hear from them again. Ghosted. Because they got liquidated.
It's the law of averages. The first thing any proper trader learns is the 1% rule.
Okay.
You only risk 1% of your total account on any single idea. Got 10 grand in your account? You're putting 100 pounds on the line. That's it. End of story.
And the new guys, I hate that. They're like, bro, I can't buy a Lambo with that. They don't get it.
They don't, because the goal isn't to buy a Lambo tomorrow.
Right.
The goal is to still be able to trade next week, next month, next year. You gotta stay in the game. This is a job, not a lottery ticket.
Weird. Okay, so that's the baseline. But what about when it's extra spicy, like now? Does the 1% rule still hold up?
It does,
Okay.
but how you calculate it has to change. Now, this is where it gets a bit more technical,
Right.
but it's crucial. It's called volatility-based sizing. You look at a chart's average true range, or ATR,
Okay.
basically how much it's swinging about on a normal day. So if GBPJTY usually moves 80 pips a day,
Yeah.
but now it's doing 250 because the Bank of Japan sneezed, you can't use your normal size. You'll get chopped to bits. You have to trade smaller to account for the bigger swings.
It's like being a boxer, innit? You don't go in there just swinging haymakers. You'll get knocked out. You've got to have your guard up, protect your chin. Your capital is your chin. So when the opponent's throwing wild punches, you tighten your guard, you move more.
Right.
For us, that means smaller size.
Perfect analogy. And that leads directly to the next point, stop losses. The prenup for your trade. You decide what you're losing before you get emotionally attached. The number of people who just wing it is terrifying.
It's insane. It's pure hope imp. Oh, it'll come back. No, it won't. I have a golden rule. The moment I click buy,
Yeah?
the very next click is setting the stop loss every single time. No debate.
But the art is where you put it.
Ah, okay.
You don't just stick it 2% below where you bought. That's amateur hour. You look at the structure of the market. Where's the last significant low? Where's that big support level? You stick it just under there where it's got a bit of space to wiggle.
And you hide it. You don't put it at a nice clean number like $50,000. That's where all the muggles put their stops. The big boys, the market makers, they see that liquidity sitting there.
Yep.
And they'll push the price down just to trigger them all. It's a free meal for them. You've got to be sneaky.
100%. And in this madness, your stops need to be wider. But if your stop is wider, your position size has to be smaller to keep that 1% risk.
Right.
See how it all links together? It's a system.
Right, so we know how to not get wrecked. But how about actually making some decent cash? Everyone's a genius at taking a tiny profit, but they let their losers drain their whole account.
That's the discipline gap. And the tool for that is a trailing stop. It's beautiful. Say you've bought NVIDIA and it's flying. You're up 10%.
Okay.
You, instead of just selling, you set a trailing stop. maybe 3% below the current price. If it keeps going up, your stop level trails behind it, locking in more and more profit. If it turns and drops 3%, bang, you're out. You've banked a solid 7% or more.
It's taking the emotion out of the win. Your greedy little goblin brain wants to hold on forever, and your scared little rabbit brain wants to sell at the first hint of green. The trailing stop tells them both to shut up.
It's your exit manager. I'll set a 40 pip trail on a Forex pair, and I can literally walk away, go to the gym, have lunch. The machine is managing my greed for me.
All right, let's poke the bear. Diversification. You guys in the TradFi world, you bang on about it. Don't put all your eggs in one basket. Sounds a bit boomerish, no?
Call it what you want, but it works. If the tech sector is getting absolutely battered because of some regulation news,
Right.
my shares in a boring old utility company are probably doing just fine. It's about not having your entire net worth tied to a single story. It's just common sense.
Seeing crypto as diversification is a myth, is a running joke. When Bitcoin decides to take a nosedive,
Yeah,
Ethereum, Solana, your dog, cat, hamster coin, they all go down together. The correlation is basically one.
I get that. It's a high beta asset class. But even within that, there are ways to be smart.
How so?
You don't just buy the top 10 coins. You can diversify by narrative. You have a bit in a layer 1 like Solana, a bit in a DeFi protocol, maybe a bit in a gaming or an AI token. It's not perfect, but it's a damn sight better than going all in on one.
Okay, I'll give you that. It's about diversifying your bets on where the crypto space is going.
Exactly.
It's a slight but important difference. But it's still nothing like your world where you can buy stocks, currencies, commodities.
Exactly. And that's the point. If stocks are tanking, maybe the US dollar is strengthening.
Right.
So I can trade that. Or maybe gold is catching a bid as a safe haven. There's always other games to play. You crypto lot are all stuck in the same playground.
Hey, it's a very fun playground, thank you very much. But you're right. So the big lesson is know the correlations of what you trade in.
Yeah.
Don't think you're diversified when you're not.
That's it. And the final piece of the puzzle is to keep an eye on the fear gauge. For me, it's the VIX, the volatility index.
Okay.
When that thing starts creeping up above 20, 25, it's a warning flare. It's telling you the big money is scared. Time to be cautious, reduce size, and don't be a hero.
Same for us. We've got the Bitcoin volatility index and the classic crypto fear and greed index. When that needle is pointing to extreme fear, that's not the time to be leveraging up your life savings.
No!
That's the time to watch, wait, and protect your capital.
The bottom line is this. Trading in volatile markets is not about being brave or having diamond hands. That's meme stock nonsense. It's about being a professional. It's about risk management. It's about surviving. The profits come after you've mastered survival.
Perfectly said. You got to survive the winter to enjoy the summer. All right, that's a wrap from us. If you want more of this and to have a laugh with a bunch of traders who get it,
Yeah?
the link to our chat group is down below. Hop in and say hello.
Get involved.
Now, here's a question we'd like you to think about. What's the single biggest risk management mistake you've ever made? And what did you learn from the pain? Let us know in the chat. We've all got stories. See you in there.